Hello, and welcome back to the Coin Story Show, where we get to hear from the leading voices in Bitcoin, financial markets, macro, and even beyond. This podcast does not provide financial advice, it is for educational purposes only. These episodes and interviews wouldn't be possible without my partners. So first up, Okcoin. Okcoin is one of the fastest growing and most secure global cryptocurrency exchanges where you can buy and learn about Bitcoin. Okcoin is committed to investing in educational content, funding Bitcoin and Lightning Network developers, as well as supporting crypto entrepreneurs from underrepresented groups so that we have a more diverse pool of talent that works on Bitcoin ecosystem projects and careers. Okcoin has contributed more than $1 million to core devs and counting, and has one of the most active Lightning nodes. I also love that you can toggle between Bitcoin and Sats mode. And if you want to get started investing, head to okcoin.com/Natalie and get $50 in Bitcoin when you sign up.
Well, David, it is so nice to see you. How have you been, especially during this bear market?
Yeah, it's been crazy this year. I think we talked in January, so a lot's happened between January and now, that's for sure.
Yeah, tell me a little bit about maybe just your overall take of the macro environment, maybe some things that surprised you and some things that are turning out the way you expected.
Sure. Um, yeah, obviously, I came into this year expecting a correction, but not nearly the correction we saw. I was kind of saying we could get down as low as 4,200 on the S&P, and it obviously went down to 3,650. Um, and the inflation obviously got a lot stickier and higher. I expected. I was one of the first to call inflation spike, but the amount of anguish over it and the Fed's slow reaction, but then reaction since to it was not in. I didn't anticipate quite what we've seen, obviously, and it has stretched everything out. When we talked in January, certainly Ukraine wasn't on the plate at that time, so that was a surprise. But other than that, I'd say, stepping back and looking at the big picture, it really didn't change a lot for me. It's just a bigger correction. People can debate on whether it's a bear market. It certainly is by most definitions, but correction, bear, whatever you call it, it's a consolidation between what I think are two very big legs. So the up leg between March of 2020 and the end of 2021, you get this 8 month, basically you made a bottom I think in June, so 6 month consolidation, and then another up leg that I think takes you to major new highs. So I'm as you know, in January, I think when we talked, I had just raised my S&P target to 6,000. And the way I work, I'm not saying 6,000 and no correction. I was looking over the correction to raising my forecast for what would come after the correction. So and I'm still there. I mean, that still to me looks very likely. It's still a high conviction forecast for me. I believe we made the lows of the consolidation in June. I have been saying I thought we could get a pullback to as low as 3,800, kind of a higher retest. In the last couple of days, I've kind of reassessed, and I think you're probably not going to get much below 4,100, 4,000 to 4,100 before you move on to much higher levels. So we might get up to 4,300 here, back off a couple hundred points, and then go. Or we might, and we could have a bigger correction at a higher level. There'll be pullbacks along the way, but ultimately, I think we're going to see 6,000 either late this year or in the first quarter.
What do you think?
Crazy as that sounds.
Yeah, well, yeah, a lot of people would argue the probability seems very low given how choppy we've been and how deep the drawbacks have been. But why are you so confident in the melt up, and what would trigger it?
Yeah, the trigger obviously is going from a headwind of Fed tightening to a tailwind of Fed pause or Fed pivot. I think ultimately it'll be a pivot, but initially it'll be a pause probably. We've had really for a year the worry about Fed tightening. It started last summer, a year ago, because there were signs that the market was overheated, the economy was getting overheated, and the inflation was starting to pick up. So all through the third and fourth quarter last year, we heard talk of tightening, and then we started seeing it obviously first half of this year. that's been a headwind that has really hung over the market. So yes, we got to new highs despite that last year, but it was kind of choppy in those last several months. And then this year, obviously, it took its toll. So I think we are, whether it's September or not, I think we are very close to a pause. And the reason I'm confident that we'll see a pause is because, and I think I've been probably one of the more outspoken ones saying we're in a recession already, and that recession is moving towards much more weakness, much more severe weakness. So the Fed's still talking about soft landing and saying we're not in a recession. I think they're wrong. And I think they're going to have a wake up call here in the next couple months. So as the statistics come in, I think we're going to see enough weakness for them to say, at the very least, we should kind of give this a little time before we hike some more. And I'm not trying to predict whether September is a 50 basis point hike or 25 or 75. I'm more focused on saying over the next couple months. And I think I said in January, and I'll say again, it's really the bond market that will lead the Fed. So even if the Fed hikes in September, I'm pretty confident that by September, the bond market's going to be much higher than it is today. Rates are going to be lower. So the Fed will have to react to that at some point in the fall.
David, when you first made these predictions and forecasts, I think the indexes were substantially higher. So the runs you forecasted were like 30 to 50% to the highs, depending on the index. So now the targets would mean that the indexes have to go, 60, 70, 90%, some of them. So are you concerned that any of those forecasts might be too aggressive?
No, because when you really think about the S&P, it was 3650 and I was talking 6,000. We're now, 4250, and it's not quite as unreasonable, right? It's amazing, and yet we're at record shorting. I just saw the greed fear. I don't know what the CNN's fear and greed index. It hasn't budged. It's still at extreme fear. The majority of investors, and particularly institutional investors out there, are still saying this is a bear market rally, right? So I think there's plenty of sentiment out there looking for 3,000 on the S&P or 3,200 on the S&P or lower, and certainly the Fed thinks that's where it should go. So I get it. I mean, I get my forecast is pretty contrary, but no, this was from the time I started talking about it back in March of 2022, or actually before that, it was always going to be something that is unprecedented in terms of the magnitude and the steepness of the run. Now, I get pushback a lot about, hey, maybe we already had the Meltup, or we already had the Meltup, in 2021. And so you were right about that, but you're wrong in terms of having raised it and expecting it to keep going. I go, yes, I agree. We had a Meltup. That was a big run from 2,200 on the S&P to 4,800. But that doesn't mean we can't have a last steeper Meltup. And maybe Meltup's the term that's hanging everybody up. It's just the steepest of the rallies in this cycle. And so I think it will go pretty vertical. That let's say we do correct back to 4,100, run to say 4,600, correct back to 4,400, and then take off. You will see the thing that I think is going to surprise everybody is what the parabolic rally looks like. You could cover 1,500 points in the S&P in a couple months. It's just we're at the end of a major cycle. A secular bull market that I say started in August of 1982, and it just all the circumstances surrounding it, particularly the amount of positioning against this market, sets up a very concentrated rally that can push them to levels that we wouldn't normally see.
So if we end up going lower, I mean, are there scenarios in which we could actually break what would have been the June lows and descend down further in the indexes and across the markets? And if we do go lower, would that change your forecast?
It certainly could. I don't, as I say on Twitter, I don't play hypotheticals because it's not what I see in my work. Could we go to 3,500 or could we go to 3,400 and I remain bullish? Yes. It would postpone everything, but I could still do that. If we go to 3,000, probably this is the bear market that's going to keep going. And, my call from 6,000 is that we go down to 1,200. So there'd be plenty of downside from there at some point, but you might have a rally from 3,000, back up to 4,500 before you did it. I don't know. But like I said, those aren't my expectations. That's not what I see. So anything is possible. I don't ever say that my forecast is absolutely correct and anybody calling for something else is wrong. We'll have to wait and see. But my convictions are high that we're not going to see those kind of levels, and quite high that we're probably not going to get much below 4,000. And that most of the sailing from here to first quarter is going to be on the upside, I think.
I think a lot of people across the board are expecting a Fed pivot because that's what the Fed has always done, but we haven't seen this much debt and this much inflation. So I know you've talked about before the fact that they are sort of backed into a corner. Does that change, how aggressively they can actually hike or how much they can start to ease or pivot because they have to take control of inflation?
Yeah, I mean, certainly that would be their mindset right now, and I'm not at all saying their mindset right now is towards pivot. I think what is going to change their mind and change all those people who are saying there can't be a pivot. There's too big a spread between inflation and Fed fund rates right now. I mean, it's insane. You're talking 9% inflation, and you're looking at a 2.5% Fed fund. That doesn't make sense to most people. But it's been a very rapid change in housing because mortgage rates went from 2.5 to 6%, right? They're back down towards 5, but you're seeing very big inventory builds in housing and retail. You're going to see it in autos, I think. So that's what a recession is inventory correction. So that's ahead of us. And what I think we're going to see is the mother of all inventory corrections. Look at the inventories at Target or Walmart. Those are not normal, even in recession times, normal inventory builds. They spiked. So supply chain is having an impact. The fact that they had to scramble and find supply wherever they could get it. Now it's all coming in at a time when demand's starting to drop off. That all spells weakness in the economy. And so I think right now the view is the Fed's really committed to inflation, and they even accept that it might cause recession, but they're going to have to deal with inflation. What I think the mindset change will come from is all of a sudden when they see that it's not a soft landing, it's a pretty hard landing. And it's not, as I say, the Fed doesn't operate in a vacuum. They also have to look at what's going on overseas. And the overseas picture is not good. And when you have a dollar that went through the roof, you're really hurting the emerging market countries that floated debt in dollars and have to pay back in dollars. They don't have the wherewithal. So there's a lot of things that are hitting. My concern, frankly, right now is that we have an inexperienced FOMC, including led by Powell, who are underestimating by a long shot how much damage they're doing. And what they are definitely doing is not understanding the leads and lags to policy. So they're waiting. It just makes no sense. The leads and lags to policy can be many, many months. So by the time you see the damage that's done, you're many months into having gone too far. I think we're at that close to that inflection point, whether it's September, October, November. we're close to a point where it's going to be, oh my God, we really blew it. And whether they'll admit it or not, the street's going to be going, oh my God, they blew it.
If you are pivoting in high inflation, does that mean that officials will basically say that it's more important to save the markets than to fight inflation? And could we see double-digit CPI?
I don't think we'll see double-digit CPI. I think we've seen the highs in inflation. That doesn't mean you can't have the next month be back up. But when you look across the board at a lot of things, and particularly in the things that are demand driven, the commodities are telling you lumber was at 1,700 and it's down under 500. Copper was at almost $5 and it's down to fell down to 3.25 or whatever. So you're seeing some of the economically sensitive oil obviously went from 130 down to 90 or down to 88, I guess. So you're seeing things, gasoline starting to roll over. You're seeing things that basically say, yes, they've already reached that inflection point. It's rolling over pretty hard. And I think will over time. It's not going to be a straight line every month telling you better news on inflation. But, economists that do look forward instead of looking at current information are recognizing the damage that's being done. And then you look at other criteria like consumer confidence or Michigan consumer sentiment, or you look at shipping rates, et cetera, and you're seeing some very dramatic declines in things. You look at savings rates have fallen from 35% to 4%. There's a lot of signs out there that we're heading for a crash, in the economy, and they seem oblivious to it because they have bought into this mantra that Jerome Powell is going to be the next Volcker, and he's going to be the guy that saved the country from that inflation bubble, and gave the tough medicine in spite of how hard that was to do. And I mean, it's a very different time. And actually, your question about debt and derivatives is the reason why I think they won't have the luxury of being able to say what they're saying now for much longer. We're gonna let the market go down. We actually want the market to go down. We're gonna ignore the weak economy because we have we have to get this inflation down. They do not understand just how leveraged this system is and what that leverage means in terms of the magnitude of the damage that they're doing. So, the real question probably is, do we get a disaster in terms of financial collapse, financial crisis and economic crisis before they wake up, and meaning that happens before the market can move. And I don't think that's the case. I think we're if they continue tightening for another 6 months, yeah, you're going to see that. But I want to talk about pivot a little bit in terms of, I think most of the rally happens before a pivot. As I said, the bond market will be moving. I think you'll see a 2% 10-year within a few months, if not sooner. So that will be the things that will be moving the market. And they very well may not feel comfortable. They're just starting QT now. They may not go from QT to QE this year. So I'm not betting on a pivot for the market, but I'm also calling for a global bust next year. So whether they pause and then go into pivot next year, a pivot's coming one way or the other. The question, but it's the market may have moved entirely on a pause and not a pivot.
It's really interesting when you do hear the Fed officials come out and they're talking almost every week, even though the meeting's happening, once a month, and they actually believe, or they claim to believe, that we could get to 4%. I mean, some of this must just sound ridiculous to someone who has so much experience, right?
Well, it's not experience, because like I said, that would make sense if you're at 2.5 and inflation's at 8 or 9%. In normal times, you'd be saying, of course, we have to go to 4 or 5 or 6%. But it's just the nature of the cycle we're in, that that's not the measure of whether you're tight or not, whether you're at a high enough Fed fund rate is not the measure. And you can determine some of whether you're at the right place or not by the 10-year, not by that. We've got an inverted yield curve. You've already seen the bond market do a lot of the tightening as we're seeing the economy slow. So it's not so much what the Fed's acting like they're the ones that have to slow the economy. The bond market's already done it for them. And because of the leverage, it happens, it's more sensitive to that, so it reacts faster and more dramatically. So it's not that it's a crazy notion that rates have to go higher. And by the way, when you see Mary Daly and Bullock and forget who else was out last week, that was a very, it was pretty obvious. That was a very orchestrated thing. And I actually called it the week before. I said, you'll see the Fed officials out trying to walk this back, because right after the Fed meeting, I heard, I watched the whole conference and I came away saying, Powell's not there yet. His mindset's not there yet. He still expects that we're going to be raising rates. But all he did was say, we're at a neutral rate, and the street took that ball and ran with it, or at least the ones that wanted to be bullish did. So all of a sudden, I have to imagine the FOMC governors were probably all sitting there, Powell's sitting there going, what in the world? I thought I gave a bearish statement. I thought I was pretty clear that rates are going higher and that we have a pretty clear roadway ahead. And all these people are saying I was, I'm a dove now. So he marched out some of his officials and said, you got to walk this back. So, Mary Daly's statement was, if she believes what she's saying, she's scary. But I don't know if she believes her or whether they're just trying to talk the market back down. Because they are totally, based on their comments, they are totally oblivious to the damage they're doing. But I think that's where I do think their mindset is that we probably have to do another 50, 75 in September and maybe another 50 in November, or what have you. So I'm not doubting that they are still in a tightening mode. I just think that there's going to be enough information coming out in the next 2 months to change their mindset.
So just to clarify, can you share just very directly, when you say Fed pivot, does that mean quantitative easing and injecting a bunch of liquidity into the market again? Because basically in the response to the crash that you're forecasting, that's when the unprecedented money printing happens, right? So what is the Fed pivot entail in terms of just liquidity in the market?
Yeah, keep them out. Like I just said, I'm not looking for necessarily a Fed pivot this year. I'm looking for a Fed pause. They may or may not pivot in October, November, December sometime. But I'm not betting on that. I don't know if they would. Like I said, it's a little hard for me to imagine them going from just starting QT to that. But again, we don't know what the statistics, if the economic numbers come out so weak, they may say, okay, all the bets, all the tightening's off. We're going full bore the other way because we went too far. So you don't know what month that will happen. So that could happen this year or in the first quarter. I think what's confusing to people is when I talk about the melt up and then I talk about a global bust. And I think people think you're going to have some recovery in the economy and then a bust. And I say, no, the seeds of the bust are already sown. They've already over tightened. We're already, in my opinion, in recession, or certainly heading for one very soon. That recession is the precursor to it's all the same downturn. You just go from a recession that begins to, that the Fed initially thinks is a soft landing, and it goes from soft landing into something severe. So it's all part of the same downturn that's already started. But you can have the market move up because the market sees the Fed pause, and the market can think, okay, the Fed is going the other way. We can look over the trough and look at 2023 earnings or second half 2023 earnings and start calculating the next cycle. So just because I'm calling for a global bust doesn't mean that's what the street expectation is going to be, right? But I think we're heading for a bust now. It's not that we're going to have a soft landing and then a bounce and then a bust.
Mm.
It's all part of the downturn that's already started.
Got
And
it.
so the pivot is really, whether it starts this year or next year, it's ultimately going to move into tens of trillions of dollars being thrown into the system, and every central bank in the world doing the same thing. So the bulk of that pivot happens, or the bulk of that easing happens when the economy really hits the skids, but it could start late this year or early next.
Got it. Okay, that makes so much sense. So how will we know when the melt up has actually started? Are you waiting for the 200-day moving average to clear, or is there another indicator that would signal that the coast is clear and now we can make a run for it?
Yeah, so that's the other confusing part is, I probably created this myself. I talk about the final melt up leg, but it doesn't start as a melt up. It's a new leg. If you go back and look at the move from March of 2020 to December of 2021, and you see that it's all, there were ups and downs in it, but it was a very clear up leg, right? So that's what we're going to have, is another clear up leg, except I think it'll be faster and steeper. But it doesn't start out the parabolic part of a leg is the latter part of the rally. So it starts out as a normal rally, just like it has 3650 to 200, right? What we've had in the last 2 months. Then it goes from there. And like I said, it could go to 4,600, pull back a couple hundred points before it goes higher. I think the real parabolic part of it, where it almost goes vertical, happens after we make new highs. So somewhere above 4,800 or above 5,000, that last 1,000 points, you could cover that ground in a month or two's time. So probably a couple months time, it would make sense. But so that's why it seems so insane to talk about, having it all happen within 6 months or less. But it's because, half of what's left to go could happen in a month's time. So, it can kind of go in a more orderly rally fashion. And then the true melt up aspect of the rally is that last parabolic part of it. So as I said, I believe the up leg started in June. We made the bottom in the first half of June. So we've already covered, um, you know, almost 600 points of the S&P. And let's say we cover another 600 points in the next couple months, getting you up to 4,800, and then the last 1,200 points you could cover in a couple months.
Well, David, your prediction is that the top will be followed by the deepest financial assets bust in modern history, right? That would be worse than 08, 09, the worst financial crisis that any living person has experienced. There would be bank failures, possibly the failure of the euro, that the highs won't be revisited for decades, and that the money needed to print in order to stop the crash is going to usher in a massive inflation crisis. It could, potentially put the United States at risk because it's going to maybe fail to meet the obligations of Social Security and deposit insurance guarantees. It could usher in world war. I mean, some of these predictions are very scary, even for a contrarian. So first of all, is there anything that the Fed could do to anticipate this and prevent it at this point? Or do you think that it's basically unstoppable?
Yeah, first, let me just say that some of what you talked about, people get them out of sequence. I just want to make sure for people listening to this, the part where governments can go bankrupt and we can see the Fed shut down and unable to print more money, et cetera. That's late this decade, early next at the earliest. So that doesn't come during the inflation part. That comes at the end of the inflation cycle, when you just can't pour more fuel on the fire because it just inflation's already spiking. And the loss of reserve currency is probably later in the decade, late in the decade. But where we're going on the way to that will be a weaker dollar and trouble ahead. So it all In other words, it evolves to these things. It doesn't all get there in a couple of years. So people, as I say, traders' minds can put it all in there, and it happens fast in their minds. They have to realize economic cycles evolve and happen over time, and that's why lots of times people think when things have taken longer than I talk about, and I'm unconcerned by it, they're thinking, hey, I'm watching this day by day, and a year's a hell of a long time, but it isn't in an economic cycle. So that as a preface. The Can the Fed do anything about it? Yeah, if you had the right people at the helm and they understood some of the things I've talked about, then maybe you could smooth out the cycle and avoid some of this. It'd be very hard to do. The biggest part of this that I think people don't understand, or some people don't, is when we get into this bust, and it's just it's 2008-9, maybe on steroids, or certainly time, but somewhat similar to that. And when you get into that and you've got financial institutions failing and you've got a financial crisis that is right in front of you, a Fed's not going to be able to say, hey, I'm going to be patient with this. We're going to let some of this happen. We're going to, be careful not to print too much money because we know what the long-term consequences of that are. They're going to be dealing with what's front and center now. And that is, our people are suffering, our institutions are failing, this thing's going down fast, and I'm at the helm and going to get blamed for it all. So they need to react. And the only thing they can do, if you've got failing institutions, failing financial institutions, the only thing that they can do quickly is print money, right? I mean, you saw in March 2020 was a microcosm of it. You saw the Congress acted pretty fast for Congress and put money out there, from a fiscal side. But the thing that really turned us while we were shutting down the entire global economy was the money. Printing $5 trillion is unprecedented, and it was the thing that saved the cycle. This is going to be that times 5 or 10. So you'll see maybe 20 trillion printed from the Fed, and like I said, proportionally from all central banks, because there'll be so many banks in trouble, so many financial institutions in trouble, and they're going to have to bail them out or say, if you cry uncle, this thing just collapses. So they will, if they have the wherewithal, they will. I mean, that's the simple statement. If they have the wherewithal, they will not let the system fail, right? The difference between this so-called global bust that I've named and the 2030s collapse that I've called for, the difference between the two is that in the 2023 global bust, inflation will be back down towards zero and going into deflation. In that period, you can print money all you want because it's not inflationary right in front of you. It is with a lag. In the 2030s, we're going to be dealing with hyperinflation, 20% plus. Central banks are out of the picture. You can't go into a California forest fire and say we're pouring gasoline on this fire because it's a liquid. It'll slow it down. It'll just make it worse, right? You can't pour money into a hyperinflationary economy, and all you're going to do is make it worse. So basically, you're going to have central banks around the world shut down going into the 2030s, and you're going to have interest rates at high double digits, and federal budgets that are through the roof. I mean, if people think 300 trillion in global debt is a lot, don't blink, because by the end of the decade, it's probably 450 to 500 trillion. And most of that will be sovereign debt that was expanded during this global bust. How do you finance 500 trillion in debt that was issued when rates were 2%, and now you have to service that when rates are 15% or 20%? you can't, it collapses.
Mm-hmm. Well, I mean, you mentioned that there is something that they could do to at least smooth the cycle. So if you were in charge, if you were in the Fed, what would you do?
We're going to take a quick break from the show to hear from these sponsors. First up, Bitcoin 2023. That's right, plans are already underway for the biggest Bitcoin conference in the world. It's going to be held in Miami next year, next May, and you can get your ticket with 10% off using the code HODL, HODL. This is going to be an incredible event. It grows in size and scale every single year. Take a look at this video from last year where you can see amazing speakers like Michael Saylor, Jack Mallers, Kathy Wood. I was so grateful I got to anchor Bitcoin Magazine's live desk at Bitcoin 2022 and hear from some of the most brilliant minds in the space. You can network with companies, other Bitcoiners from around the world, and the parties and events going on in Miami Beach are pretty amazing as well. And if you don't want to wait until May, I understand. How about Bitcoin Amsterdam? That's going to be held this October. It's going to be the first big Bitcoin conference in Europe, and you can get your ticket at b.tc/conference for either Bitcoin Amsterdam or Bitcoin Miami 2023. Again, use the code HODL, HODL, for 10% off your pass. This episode is also brought to you by Fold. How would you like to earn Bitcoin on every single purchase and spin a fun wheel so that you can earn sats every single day? Fold is the best Bitcoin rewards debit card and shopping app in the world. Whether you're shopping at Amazon or grocery store or anywhere that you go, you can earn Bitcoin on every single thing you buy with Fold's Bitcoin cashback debit card. And you can spin the daily wheel, which is super fun, to earn more free Bitcoin. And people have actually walked away with one whole coin on this thing. Head to foldapp.com/Natalie and get 5,000 sats when you sign up. Now back to the show.
Well, I mean, you mentioned that there is something that they could do to at least smooth the cycle. So if you were in charge, if you were in the Fed, what would you do?
First, they would never take in somebody like me. The FOMC is a very collegial, consensus building group. So you bring in a contrarian with these kind of views, and you'd be, even if they made the mistake of appointing me, I'm sure a month later they'd be saying, "Where do we get this guy? He's got to leave." This is, so realistically, I don't think that would ever happen. But if somebody could work with them, it's very late now, so it'd be very hard to do. But the prescription would be to try to smooth this out in terms of realizing that you've already gone too far, and if you go much farther, you're gonna have to turn on a much bigger spigot. In other words, the more they tighten, the more the response on the other side, right? And the bigger the inflation cycle. And once you get that true inflation cycle that's can't be stopped, because by the time you recognize how much money, how much inflation you've caused, it's way out of control. It may feel like that right now. Like I said, wait a few years, and you're going to see something way beyond what we have right now. It's the leads and lags, and if you could, Greenspan tried this back when he was chairman, and that's why we had a very long, elongated cycle. Is he started reacting ahead of time. He started anticipating things. The Fed is always reactionary. If they could be anticipatory, and right now it would be a matter of saying, "Hey, we've conquered inflation." That doesn't go well on Wall Street right now because people can't see that yet. Some hopeful people think it might be, but the majority of people think inflation's got a long runway ahead, or that they have a lot of tightening to go before they can really turn it over. If you could understand that you've already done the damage, you've already done the work, and pivoted now, and pivoted in a significant way, you probably could avoid a bust and at least postpone all the things I'm talking about. But I think we're basically not on autopilot, but we're basically we've sown the seeds, and I think you're going to reap what you sow. And unfortunately, I think global bust is already in the cards based on what they've done this year. And
That's so interesting. It's interesting to hear you say that the bust could be avoided at all, because it just seems like with the debt construct that we're moving in this direction, slower or faster, but no matter what, this is gonna come cascading down at some point. And actually, the longer we delay, it might make it worse, right? Because we keep propping up these bubbles so they get bigger and bigger. So when the crash finally happens, it's more and more painful. But I mean, just hearing you mention that we could potentially avoid the bust, like I mean, how at this point?
yeah, I don't know if I mean avoid. You could change the shape of the cycle. In other words, you could stretch it out. You could put off um, what I'm describing, maybe, and it's a long shot, but you could maybe avoid a bust this cycle and then have it next cycle. So you might push out a collapse further, or change the shape of the cycle. So there's certain things that could be done that could, in other words, a global bust next year is not an absolute given. I think the seeds are sown and it's pretty likely, but there probably are still some things you could do to stretch it out so it might happen a year later or it might be pushed off further. But you're right. I mean, ultimately, what we are heading for, whether it's the timing could be off by 5 or 10 years, but what we're heading for is a collapse of the Ponzi scheme. This Ponzi scheme that's been in place since the Great Depression, that started building after World War II and really accelerated in the last 3 decades, in particular the last decade. It's when the music stops, when inflation breaks out to the levels I'm talking, the game's over. There's and that's when the collapse comes. So, and it's we are so focused on the U.S., but this is across the globe. China's obviously more leveraged than we are, and there's Europe's in trouble, Canada and Australia are in trouble. Japan's in trouble. So you've got almost an inevitability to it. I in markets, I hate to think anything is inevitable, but it's the closest thing to it, that's for sure.
Well, I just wanted to ask you, being a contrarian, what was your greatest, I guess, successful prediction in your career on Wall Street? And maybe what was your greatest miss?
I don't know if it's greatest prediction, but it was certainly one that really set me off on my course. I was running Textron's in-house equity pension fund. I went in there. I was barely 30 years old, and they had been hurt in the '74 bear market, which was the worst bear market until 2008-9. Their chairman, who was G. William Miller, went on to be Fed chairman, brought all the money in-house. Said, I never wanted, this was back in, after the '74 crash. So I never want to face he had a lot of, 50 and 60-year-old senior management that were approaching retirement. So I never want to have to face my people again who are close to retirement and tell them that half their pension money's gone, because of what happened in the Nifty 50 crash. So they pulled all their money in house. They were, the first conglomerate anyway. So they were used to doing kind of leveraged buyout type work. So they brought all the money in and they did fixed income and private placement type work, and instead of equities. And they had a small 10%. When I went in there, they had 10% in equities and 90% elsewhere. But they missed the oil market. I went in late '81. They missed the 1980-81 oil market. So they dropped to the second quartile. They had been a first quartile performer since they brought it in house. And because they didn't have the energy sector in their portfolio, they didn't have equities in their portfolios. They dropped to almost 50 percentile. So they put out a search, and I answered that search, and I was told by everybody I knew on Wall Street said it's a dead end job. If you're an equity guy, you don't want to go in there. They hate equities. And I was, like I said, I was 8 years into my career and had been in banks for 8 years and had developed a sense that I could be a value manager that could perform better than most. And I went in there with typical youthful exuberance, thinking I could, and I, had to explain to them that I could I could invest conservatively in equities and outperform. So I was a value manager, and I tried to explain all that. And I was talking to these guys that were, you know, the senior management of the companies, group vice presidents, ever, they were all pretty much 60 years and up. So they're looking at this 30-year-old kid telling them that he knew best. And G. William Miller had left there to go to the Fed a couple of years before. So I didn't work under him. But he was the ghost of G. William Miller was in that room every time I went to an investment committee meeting. I would hear, you know, Bill always told us we should never do this. Bill's always warned us against equities, and I'm sitting there as this kid thinking I knew it all. But what I did, the long story short, in 1982, I went in late 81 for about 6-7 months. I built a buy list and I said, keep our powder dry. We're in the bear market. In August of 1982, we had an investment committee meeting, which was the bottom of the market. I went in and said, I think we're at the bottom of the stock market. The Dow Industrials were at 780. And I proposed, I think I asked for $100 million. They had a $50 million equity portfolio when I went in. I think I asked for another 50, and they might have cut it. I might have 50 or 100, I can't remember, but they cut it in half. And I came out of there upset. The chief investment officer is, telling me you should feel very good. This is something you just don't get equities approved that easily. And so what if they cut it in half? You made a big step forward. My big contrarian bet was, I said, this is 1982. If you look throughout institutional portfolios, they had the S&P weighting for energy back then was 33%. And a lot of people were overweighted in energy. Energy had been hit in the bear market, but people were still loaded up with it. I went in and I said, we're at the peak of inflation. What's going forward is disinflation. And disinflation wasn't a word yet, but I said, inflation is going to be ratcheted down. The Fed's policies long-term are going to be aimed at ratcheting down inflation. This is all talk you hear today, but back then this was, original thought. I'm going, they're committed to this. It'll be over more than one cycle. Inflation's ratcheting down. What you want to buy at the peak of inflation is those things that were, hurt the most by inflation. So the things that are flat on their back. So I was recommending and buying drug stocks, Eli Lilly and Merck, and food stocks. I had Carnation, which isn't even a company today, but Carnation Milk was a big food company, and General Mills and Kellogg and Philip Morris, because the tobaccos were, steady growers. And I had zero in energy, zero weighted against the 33% S&P weighting. And I said, these things are, don't look backwards, look forwards. And these are the things. Well, what helped me was the things I was recommending were blue chips, right? Kellogg and Merck. And so even though I was buying them at book value and they were, viewed as dogs on the street, the management could see them as quality companies because they were steady growers. They weren't, I wasn't buying things that were at risk of going out of business. They were well run, et cetera. But the fact that I understood that you buy steady growers when inflation's peaking. And so in the next 5 years that I ran that portfolio, we grew it from 50 million to 500 million. It became from 10% of equities. I had 50% of the pension assets were in my portfolio. And I had top 1/10 of 1% performance for much of that time. Certainly 1% performance for that time. So I was top equity manager in the SEI index for 5 years running. And it was all because of that macro understanding that, number one, inflation's peaking, and number two, I want disinflation stocks at that time. What people tend to do is say, inflation's peaking, so I'm owning those things that are looking good right now. Energy companies are making all this money. This is what I want to own. No, you want to own the things that were thrown out because they were hurt by inflation, because at the margin, you're beginning the trend in the other direction. So, and in terms of the worst one, I was a year early, and I'm a value manager. I was a year early. I went from Textron to Fidelity. I went from Fidelity to I was running the ITT Hartford Equity Pension Group. Was basically I was running the active equity portfolio. And in 1991, I said, it was kind of the reverse call from what I did at Textron 10 years earlier. And I said, all the things I owned at Textron were up through the roof. They had gone up 20 times. The consumer growth stocks, there was a chart going around in the early 90s that compared capital goods stocks to consumer stocks. And they were at, historic lows going back 60 or 70 years. Never seen them at the levels they were at. So that capital goods stocks were cheap relative to consumer. So I went in completely capital goods, had no consumer stocks, and said, this, as long as you guys aren't worried about quarter to quarter performance, if we do this, you'll see performance soar. In the next year, we had the final blow off. This is one reason why I'm where I'm at today in terms of understanding that things can take longer. That last year, we had a final parabolic blow off of the consumer growth stocks. And I had zero consumer growth stocks, and the things that were being hurt were the stuff I owned. So we lagged the S&P by 600 basis points, 6%, which wasn't bad considering how much I skewed it. But when I was brought in, they had dismantled an active equity effort years before and went index. So I had kind of as my enemy the index guys. They viewed me as their competition. So I had them going behind my back constantly, going to the chief investment officer saying, look at his portfolio, look at what we're doing. He's 600 basis points behind. And so they basically took the portfolio away from me. In the 2 years after they liquidated that portfolio, it was up 2,000%. So I outperformed by if they had stayed with it, I outperformed the S&P by 2,000%. But, they had bailed out at the bottom. So, it was a real lesson in contrarianism that, if you're early, you can be wrong. Or if you're early, you can, if people don't have the understanding of what you're doing, it can really cost you. So that's a long story, but
no, I love this. It's so interesting because I think that you've had such a fascinating career and your perspective on what's happening in the markets right now, given your experience with inflation earlier in your career. I think that's why so many people, they want to know more about your forecast, and you have such a big following when it comes to it. And it's interesting too, because you must face those criticisms, right? Well, the Meltup hasn't happened, so the forecast has failed. And right now, your Meltup for the Nasdaq going to 20,000 from the roughly 11,000 low in June. That's like a 90% up, give or take, right? So it seems unprecedented, but you seem very convicted and confident in it. This is a Meltup where, fortunes could be made and lost. But there are people that would argue there's probably less than a 1% chance that this could actually happen. What do you say to that and to the critiques of that kind of move up could even be possible?
Yeah, I have put out on Twitter several times when people criticize, when people say something like, you're insane, or I'll go, I agree, this is an insane call. What I don't think they understand is that it's not a call based on personality. I think people assume, if it's an insane call, then you're insane. Or if it's, in other words, they're thinking it's just an emotional thing. What I try to say is it's where we are in the cycle. So it's not my personality causing this. It's not me trying to make some big splash and say something that gets attention. It's where we are in the cycle. It's because we're at the end of a 40-year cycle that you can get this kind of unprecedented move. Could I be wrong? Sure. And I think people need to understand that is that I'm highly convicted on this call. but that doesn't mean that it's a guarantee or that I know it's going to happen. But I do have 49 years experience, and I do have experience with cycles. And the reason I have conviction on this is based on my analysis, not based on some superficial thing. So, but that's why I keep pushing back on people. Most of my criticism comes from people that are short-term traders. An awful lot of retail investors, unfortunately, think that investing is coming in and, watching the market every day and trying to guess what the market's going to do today, next week, and the week after. And I keep saying, my calls are big cycle calls. So, yeah, I can be off by months and years. Most of it I'm going to be off by months, not years, but occasionally I can be off by that. But it's, these are, as I say, the highs we reach in this blow off, whether it's 6,000, 6,500, 5,800, the highs we reach are probably not going to be seen again, certainly in my lifetime, but maybe not in yours. Mm-hmm. So, meaning you're young, so it may be several decades.
Well, I kind of want to touch on that because I know that you don't follow Bitcoin. You're not interested in it. But most of my followers obviously are big Bitcoiners, and a lot of them are also young or millennials. And really, we came out of school and we spent our young adult life entering our careers in the great financial crisis, starting to feel really left behind. We maybe start to get our footing in our 30s, bam, COVID, lockdowns. We have an inflationary crisis. It's harder and harder to afford a house and be able to feel like you can plan for your future. And so a lot of what that movement and what the passion, the fervor behind something like Bitcoin and the idea of creating hard money in a digital format is to create an alternative system to feel like we can actually make a change or rebuild something, burn the old system down with the old institutions that we don't trust anymore and recreate a new one. Can you appreciate any of that? Or what is your response to the fact that there is this young movement within this new digital space that's saying we need to basically recreate the economy and into one that's more inclusive, into one that people can actually build wealth, because so many people feel left behind and unable to create wealth the way that the boomer generation did?
Yeah. I'll preface it with this. As you well know, I'm the first one to say I know nothing about Bitcoin. I'm not somebody anybody should listen to on Bitcoin. And certainly, my boomer age gives me away, but I'm my view is I definitely understand the motivation. I definitely understand where you guys are coming from. I don't think it's going to work out the way the Bitcoin crowd or the crypto crowd, and I know there's a difference, imagines it. I really do feel like a lot of the interest is coming from the skepticism towards our institutions, and it's rightful skepticism. The central banks have done a terrible job. They're kind of between a rock and a hard place now, where you can't. If somebody says go back on a gold standard now, as I've said before, it'll put us all in caves, because the only thing going forward is to keep this going. And unfortunately, I think it doesn't keep going very much longer, as you know. But I think the alternative is much worse, meaning you just fast forward the pain, and it's not just a little pain; it's a lifetime of pain. So I just don't see how Bitcoin or any other outside the institution currency is going to solve the problems that are coming, because the collapse of the system, which is the majority of what's out there, is going to cause such massive deflation that I don't think Bitcoin holds up in that either. It's yes, you can say, well, it solves this problem. It gets us away from the central banks calling the shots and freezing our money or what have you, but it doesn't solve the deflation problem. So you're another asset that's going to deflate like everything else. So my problem is I think they're focused on one aspect of the problem that's coming and not realizing that it's very hard to come up with anything that's going to be a solution for that deflationary collapse. So what my advice to everybody is, and particularly young people, is don't chase rainbows. In other words, don't get caught up in the excitement of the housing now and think you can extrapolate it. You know, buy buy straw hats in the winter. Buy things when they're down. If you're going to buy a house, you're probably going to have a much better opportunity to buy that quite a bit cheaper in the next 18 months. Instead of saying, I've got to compete with 5 other people bidding for this house because if I don't buy it today, tomorrow it's more expensive. Yeah, it is for now, but that will change. Don't, if I'm right about the stock market, don't do what most people are going to do, and that is get caught in the euphoria that's going to make 6,000 look reasonable. That's what I can say with a lot of confidence, is that 6,000, you're going to have a lot more people bullish than you have today. A lot more, meaning the majority. And they're going to be having a rationale that makes sense as to why it's going to go from 6,000 to 8,000. And it's easy at the top to get sucked in. So that's why I'm a contrarian, obviously, is it's buy when everybody else is selling and sell when everybody else is buying. And you're not gonna hit it at the bottom and the top, but you're gonna be much better off than you are when you're kind of with the crowd.
Yeah, no, you're absolutely right. Thank you so much too for that perspective, because it is really interesting to see this like emerging industry, and it's still very early, and we saw a ton of wipeouts in the crypto space and all these liquidations and a lot of, new companies cross collateralizing. We have the central banks that don't want to release their grip on monetary power. So I think the next 10 years are going to be interesting, if not scary. I'm hopeful. I'm trying to be on the hopeful side. But to wrap it up, David, I was just curious, you're followed by the who's who of financial Twitter. Like anyone who is anyone in the industry seems to be following you. Why do you think that is?
To be honest, I don't know who follows me. I mean, I know I have 188,000, but I couldn't tell you what I am seeing though is an awful lot of my terms get used now that weren't terms on Wall Street before. Meltup is everywhere now. Nobody was using that term before me. Global bust is everywhere now. That was a term I was using by myself, and nobody was using the term bust in market vernacular before that. So I know that people are picking it up either firsthand, secondhand, thirdhand. Why people are following me, I don't know, because what I see every day is, particularly when the market's down, is an awful lot of people that think I'm an idiot. So I'm not sure why people are following me. But when the market's up, like it's been for the last few weeks, or a couple months, it's funny how the trolls kind of disappear. And I know they're lurking. I know they're waiting for the next chance to call me an idiot. But I know, I mean, I have no idea who's following me or what their reasoning is. But I do, unfortunately, I think this happens a lot. I should probably take it as a compliment, but people do plagiarize. I mean, there's a lot of people now saying, things that not so much right now, because right now I think an awful lot of the institutions are bearish and thinking, okay, we've had most of the bear market rally and they're starting to go the other way. So you are seeing some of the other interviews out there where people are talking what I'm talking for 2023, they're talking for now. So it's not so much that, but not too long ago, people who never thought the market was going up were talking Meltup. You go back 4 or 5 months, and I had a lot of people saying I had my forecast. So I'm much happier now because I think I'm back to being a contrarian.
Well, it's always awesome to hear your perspective, your forecast. Thank you so much, David, for joining me again.
Sure. Thanks, Natalie. It's great to see you again. If people do want to follow me, it's at Dave H. Contrarian. And as I always say, I do write a quarterly letter. If they're interested in details, it's by subscription. Just direct message me on Twitter.